Congratulations, you're taking a big step towards a career in real estate. It's an exciting world, full of opportunity. But before you can help others buy their dream homes, you need to understand the ins and outs of real estate financing. Trust me, it's not as scary as it sounds. This guide will walk you through the essentials, from different types of loans to important legal concepts. We'll use clear language and real-world examples to make it easy to grasp. By the end, you'll be well on your way to acing that exam and launching your real estate career. Financing is the backbone of real estate. Without it, most people wouldn't be able to buy homes. That's why it's crucial for you, as a future real estate professional, to understand how financing works. You'll need to guide your clients through the process, answering their questions and helping them make informed decisions. Think of yourself as a financial matchmaker. You'll be connecting buyers with the right loans to suit their needs and financial situations. This involves understanding their income, credit history, and how much they can afford for a down payment. It also means knowing the different types of mortgages available, their terms, and which lenders offer the best rates and programs. Mastering these concepts will not only help you ace your exam, but also set you up for success in your real estate career. So let's dive in. Let's start with the basics. Mortgages. A mortgage is basically a loan specifically designed to help people buy real estate. Think of it like a giant IOU secured by the property itself. Now, there are two main flavors of mortgages: conventional and non-conventional. Conventional loans are your everyday mortgages, offered by banks and lenders without any government backing. They're like the plain vanilla of the mortgage world, straightforward and reliable. These loans typically require a good credit score, think 620 or higher, and a larger down payment, often around 20% of the purchase price. On the other hand, non-conventional loans are backed by government agencies, making them more accessible to a wider range of borrowers. These loans are like the specialty flavors. They come with unique features and benefits. The most common types are FHA, VA, and USDA loans. FHA loans are insured by the Federal Housing Administration, making them great for first-time homebuyers or those with lower credit scores. They require a smaller down payment, as low as 3.5%, and have more flexible credit requirements. VA loans are guaranteed by the Department of Veterans Affairs and offer amazing benefits to eligible veterans, active duty military personnel, and surviving spouses. These loans often require no down payment and have less stringent credit requirements. Lastly, USDA loans are geared towards borrowers in rural areas. Guaranteed by the United States Department of Agriculture, these loans also offer low or no down payment options and flexible credit guidelines. Now that you know the main players in the mortgage game, let's break down the specific requirements for those popular government-backed loans: FHA, VA, and USDA. FHA loans are designed to make homeownership achievable, even with a less than perfect credit history. To qualify, borrowers typically need a credit score of at least 580 with a 3.5% down payment, or 500 with a 10% down payment. They also require a debt-to-income ratio, or DTI, below 43%, meaning your total monthly debt payments shouldn't exceed 43% of your gross monthly income. Keep in mind that FHA loans come with mortgage insurance premiums, MIP, to protect the lender in case of default, which adds to your monthly payment. VA loans are a fantastic perk for eligible veterans and military families. The great news is that the VA doesn't set a minimum credit score requirement, although individual lenders might have their own guidelines. Similar to FHA loans, there's a DTI threshold, typically around 41%. The biggest advantage of VA loans is the potential for no down payment, making homeownership more attainable for those who've served our country. USDA loans target borrowers in rural and some suburban areas, promoting homeownership in these communities. Like VA loans, USDA loans don't have a set minimum credit score requirement from the USDA, but lenders might have their own. Income limits apply to ensure the loan program benefits those who truly need it. And the best part, USDA loans often require no down payment, making them a fantastic option for eligible borrowers in designated areas. Remember, these are just the main points, and specific requirements can vary depending on the lender and individual circumstances. It's always best to consult with a qualified mortgage professional to get the most up-to-date and accurate information. Now, let's unravel some legal jargon that's essential for your real estate exam: lien theory, title theory, and deed of trust. Don't worry, we'll keep it simple. In many states, mortgage transactions operate under something called lien theory. In a nutshell, this means that when you borrow money to buy a property, you, the borrower, actually hold the title to the property. The lender, on the other hand, places a lien on the property, which gives them a legal claim to the property if you fail to repay the loan as agreed. Think of it like a safety net for the lender. In contrast, some states follow title theory. Here, the lender holds the legal title to the property until the mortgage is fully paid off. The borrower has what's called equitable title, meaning they have the right to possess and use the property as long as they keep up with their mortgage payments. Once the loan is paid in full, the legal title is transferred to the borrower. Now, where does the deed of trust fit into all of this? A deed of trust is a legal document often used in lien theory states. It involves three parties: the borrower or trustor, the lender or beneficiary, and a neutral third party known as the trustee. The borrower signs the deed of trust, temporarily transferring the legal title of the property to the trustee, who holds it as security for that loan. Once the loan is fully paid off, the trustee transfers the title to the borrower. If the borrower defaults on the loan, the lender can instruct the trustee to sell the property to recoup their losses. Understanding these legal concepts is crucial for your real estate exam and for navigating real-world transactions. It ensures you can confidently guide your clients through the intricacies of property ownership and financing.